Hello and welcome to the next in the series of videos that relate to boot camp uh, learning issues for the Huntsville I2C series. I am Roger Spain with Warren Averett. We're, of course, a CPA firm that is, throughout the Southeast, including in Huntsville, but also in Georgia, Florida, and several other places and states as well. I work in the area of outsourced CFO services, and I offer that to you merely so that you'll have an appreciation, perhaps, of where I'm coming from as I present this material. Today, and through or in this segment, we're going to be focusing on financial ratios, particularly balance sheet centric financial ratios. So we will spend just a second reviewing where we have come from our starting point, and then pick up with what to do with the information that we've learned in the previous videos that we've posted. With that, let's start with a review of the financial statements. We're going to be talking about financial ratios, but let's first take less than a minute to review the data that we're using. The data that we're going to be using as we talk about financial statement ratios or financial ratios, and in this segment, again, balance sheet centric ratios. Those are going to be based on the financial statements. Well, what are financial statements? So to review very quickly, financial statements consist of an income statement, which most of us think of as the first element of financial statements, the profit and loss statement. It shows the income, less the expenses, and ultimately the net income of the company. Next is the balance sheet. It is reflective of the financial position of an entity at a particular point in time. The income statement is a bit like a movie. It shows what happened over a period of time, a fiscal period. The balance sheet is more like a photograph. Where is the company as of a specific point in time? Statement of cash flows is on a cash flow basis, income statement type information. So instead of looking at accrual basis financial information, a statement of cash flows is how did the company perform over some period of time as it relates to cash inflows and cash outflows in that company. Last is the notes to the financial statements, and that is explanations of the numbers in the above statements that we just talked about. So there's a quick review of what are financial statements. Now let's talk about what to do with the data that is in those financial statements in order to give management or ownership a good indication as to how the company is performing and how it may expect to perform going forward. As we do that, let's think again, or review very quickly the limitations of financial statements, and this is applicable as we think about what I just talked about, which is how do we use the data. Let's recognize that the data that we're talking about in financial statements is historical, and it is not based on necessarily fair market values. It is historical data. Next, it's conservative. It is intentionally not information that will reflect the full value of a company or some of the values associated with the company's customer list, for example, things like that. It's conservative in nature. And lastly, it's limited to financial information. The financial statements are limited to financial information. So how many customers a company has will not be reflected in the financial statements of the company. It's an important number, but it's not reflected in the financial statements. So with those limitations, now let's see what sort of analyses and ratios we can look at in order to assess a company's performance, as well as where we can expect it to go. I talked just a minute ago about the fact that we're going to be looking at balance sheet centric ratios in this video segment. So let's review very quickly what a balance sheet is, what it consists of. Generally, we see assets on the left-hand side of a balance sheet and who has claims on those assets on the right-hand side of the balance sheet. Claims would be third parties, such as current liabilities for accounts payable and long-term debt. And then what are the residual claims against the assets that the owner can claim ownership to or has a claim against. So if we think about all of the assets of the company on the left-hand side, who has a claim on those assets? We start with current third-party claims, then long-term third-party claims. And if there are assets left over after the satisfaction of those third-party claims, that goes to the owners. That's their equity in the company. Keep in mind, too, that a balance sheet is classified in terms of current versus non-current assets and liabilities. That'll be important as we start looking at ratios. Current assets are those generally that we expect to cycle through or turn to cash within a year, if it's not already cash. Liabilities, if they're current, sort of the same thing. What do we think will be coming due within a year? Versus long-term liabilities or long-term debt, which is what is due outside of a year from now. With that as a backdrop, let's start into the balance sheet centric ratios. There are generally two types. First is, what are the current or immediate solvency focused ratios? And those focus on a company's ability to meet current obligations with current assets. The other general type of balance sheet centric ratios are capital structure focused. These address issues related to where did the company get its capital and how is it managing debt, and relatedly, how much risk does the company carry as a result of how it is capitalized or sourced its capital for its efforts, recognizing that debt brings with it risk because that debt must be repaid and the interest must be paid annually as well. So that's a higher fixed cost that must be met every reporting period, every quarter, every month, every year. So that brings more risk. With that, let's get into the first, or current and immediate solvency focused balance sheet centric ratios. There are a couple that come to mind here. First is the quick ratio. It is current assets. I've shown you the formula here. Current assets, less inventory, divided by the current liabilities. So that would be how much cash or things that are nearly cash do you have available to pay your current liabilities that might be coming due very soon? This is called the quick ratio. Anything greater than 1 is considered good and considered healthy. The next ratio is the current ratio. It's simply current assets divided by current liabilities. I tend to look at this a little more than I look at the quick ratio because here you're including inventory that you certainly expect and hope to sell. Many of the current liabilities that you might have within a company are also related to that inventory. So hopefully the two go hand in hand. Here, you're looking for a ratio that's higher than 1.5 to 1 to indicate health within a company. If a company has a ratio less than these recommended ranges, it could be a timing issue, and it could be a reflection that the company is in a bit of a cash crunch as a result of a number of factors. Many things can lead to that, but this is intended to, this is a good window into how is the near-term solvency of the company, and how might one measure that, and how one might assess that. So now let's shift to capital structure focused ratios. These ratios tend to look, whereas the solvency ratios look at very short-term issues, these ratios tend to address the longer-term issues that are reflected in the balance sheet. These ratios tend to address how the company has gone out and gotten capital or financing, whether that's equity that the owners have contributed, or whether that's borrowed money from a bank or some third party. As we think about the capital focused ratios, we'll start here with the total debt to equity ratio. That is simply total liabilities divided by total owner's equity. It gives someone an indication as to how much money the company has borrowed versus how much money the owners have put into the company. All companies need capital. All companies need cash. All companies need assets. How did the company source its capital? How did the company fund the acquisition of its assets? That is shown in this simple relationship of total liabilities divided by total owner's equity. To give that some context, let's now look at the second ratio very quickly. And let's talk now about long-term debt to equity. Whereas the first ratio was focused on total liabilities, that would include accounts payable and current liabilities. Here in the second ratio, long-term debt to equity ratio, we're looking really at the long-term sources of capital. That's borrowed money from banks that are long-term borrowings, as well as the owner's equity, where the owner has put money into the company. What is that ratio, or what is that relationship? Generally speaking, a company that is pretty healthy and operating at a risk level that is considered more tolerable, that ratio will be less than 2 to 1. If you think about that, that means if a company were to borrow, say, $200,000, and the owners put in $100,000, that would get us to this 2 to 1 ratio. That would mean that 2/3 of the long-term capital used in the company came from banks, and 1/3 came from the owners. The reason that carries more risk than, say, the owner putting in all of the equity or all of the capital is that the bank is going to require an interest payment and probably a repayment of some debt. And the bank does not take kindly to not being paid on a timely basis. And therefore, there's risk associated with the company being able to operate effectively enough to meet those minimum interest and principal required payments. So that carries more risk than, say, the owner preferring to get a dividend, but being able to skip a dividend without any real negative consequences. So debt carries more risk, and so a higher long-term debt to equity ratio also reflects more risk in a company. As we move down, long-term debt as a percentage of total liabilities, this gives us an indication as to of the money that we owe, what percentage of it is long-term debt. Conversely, we can do the same with short-term debt as a percentage of total liabilities. How much of our obligations to other folks are due in the near term relative to all of the obligations that the company has. Total liabilities as a percentage of total assets. Here we simply look at, of the total assets of the company, how much of that is owed to third parties. Long-term debt as a percentage of total assets, which is the last one, is an interesting one to me, and one I like to look at, because you look at the assets of the company, and this ratio tells us what percentage of the dollars used to acquire the assets of the company came from third-party long-term borrowings. In other words, the assets the company has, this tells us how much of those assets were acquired by the company with borrowed funds, long-term borrowed funds. So what all of these tend to reflect is how much risk and how much leverage or borrowings the company has. I gave you a 2 to 1 on the long-term debt to equity ratio. That one's pretty important. These others can give you a pretty good indication as to the mix of long-term versus short-term, or how the company may have financed its assets. I hope these are helpful, and if you want to do some research on the internet, or and to see what levels one might expect to see other companies reflecting with these ratios, you can certainly do that. But using that benchmark of 2 to 1 for long-term debt to equity is a good place to start. So I hope this is helpful. As we think about this, I want to remind you of just a couple of things. That as we look at balance sheet centric ratios, keep in mind that these are based on the cumulative effect of operations, because the balance sheet reflects the financial position of an entity at a point in time that is reflective of the cumulative efforts since it began operations. And that is also, that bears out as one looks at these ratios that are balance sheet centric. The other is these ratios will help an analyst or owner address the current status or current health of the enterprise. Where is the company at the date of the balance sheet, and what is its relative health based on these ratios? How much risk is inherent in the company using these ratios? How healthy, how solvent is the company relative to its ability to meet near-term obligations using these ratios to make those calculations? I hope this is helpful. And as always, if anyone has any questions after watching this, feel free to reach out to me at Warren Averett. Be glad to help or glad to answer any questions. And until next time, I hope this has been helpful. Thank you.